Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and today is Jobs Day for the month of August 2022, and we've got our normal crew here of Moody's Analytics economists. We got my co-hosts, Ryan Sweet and Chris Dorides. Hi, guys.
Hey, Mark.
Mark,
Where are you?
Good to see you. I am in Boston. I'm moving my daughter into an apartment, and she's starting graduate school on, next week sometime after Labor Day. So, and right now my wife and daughter, well, let's not even go there. A lot of stuff going on here.
Well, I guess
anyway.
the most important... Wait, are you going to a Red Sox game?
Oh, you know what? I didn't even think about that. I mean, I'm like literally just around the corner from Fenway Park. I could go there and boo, you know? I could do that.
Where is she going to school, Mark?
She's going to Boston U. She's getting a master's in bioinformatics, which is kind of interesting. Yeah.
That's Marisa's alma mater.
Yep.
Oh, it is?
Mm-hmm.
You know, here's the weirdest thing. I had never run along the Charles River. Never. I've always wanted to do that. Yeah. And I did it yesterday. A gorgeous day here in Boston, and ran along the Charles River. Really had a lot of fun. So felt my age though. Really, all these young women passed right by me, and I'm going, "What the hell? I can't even hang." You know?
Well, they are in college, Mark.
I know, but still, you know. Anyway, and I see Ryan's back. Oh, by the way, it's Marisa. Marisa, DiNatale, good to have you on.
Hi. You're
one of the key contributors to Jobs Friday, and I should just to round it all out, introduce Dante DeAntonio. Sorry, Dante. Good to see you.
Good to see you, Mark.
Yeah, very good. And we got Ryan back. Ryan was away for 2 weeks at the beach, and you definitely look like you were on the beach, Ryan. Probably looks like you had a great time.
Yeah, we had a wonderful time. I'm jealous. Dante's still down there.
Oh, is that right? Is that right? Yeah. Where are you, Dante? I know.
Ocean City, New Jersey. It was right down the street from Ryan.
I see each other on the beach, make sandcastles together and that kind of stuff.
Yeah, our kids were playing together.
Bonding.
Yeah.
Yep.
Oh, really? Your kids were playing together?
Oh, yeah.
Cool.
You'll see the expense report come through. Yeah, we were having a meeting on the beach, so.
All's fair. I get you guys work all the time, so that's definitely fair. Anyway, okay, Jobs Friday. Well, I'm really curious what people think, so we'll dive right in. I've got a view, but I won't tell you what that is until you give us a sense of the lay of the land here. So, Ryan, I think you volunteered to give us your first take on the report. What's your view on the numbers?
All right. So overall, the economy created 315,000 jobs on net between July and August. A little bit better than what we and the consensus anticipated, but it's a step down from what we've seen over the last few months, trend-wise. So basically, the takeaway is the Fed is getting what they want. They want job growth to slow. They want wage growth to slow, which we saw with average hourly earnings. They want the labor force to increase, which it did. And the reason the unemployment rate increased from 3.5% to 3.7% is that we got a pretty good increase in the labor force participation rate. My favorite indicator, the prime age employment to population ratio, went from 80 to 80.3%. So that's another good indication. So all in all, I think it was a really good report. I mean, there's not a lot to, a lot of blemishes. I mean, people may point to the unemployment rate, but it rose for the right reason. More people came into the labor force. And if you look at the labor force flows data, the number of people that are going from out of the labor force to unemployed increased. So people are coming back in. I think that's a good indication. I guess, if you have to dig and, try to nitpick, the duration of unemployment increased. So there was more people that were unemployed, 5 to 12 weeks or 27 weeks and over. But again, that's kind of what the Fed wants. They want the labor demand to soften, and that's going to keep people unemployed for a little bit longer. But getting back to that 315,000, the breadth of job growth was still very, very strong. So all in all, I think it was a pretty good report.
Yeah, let me ask you, and maybe this is not the best thing to do right immediately, but getting down into the DNA of the numbers, August tends to be a soft month, right? I mean, if you look historically, the BLS generally comes out with a number for August that looks a little on the soft side. In fact, I can remember, I think it was coming out of the financial crisis, and we were all, waiting for the job numbers to improve, and they had been improving. And then I think it was August of 2011, maybe, or 2010. No, it was August of 2010. We came in with the zero jobs in that month, and everyone went into panic mode. But it just feels like every August we get surprised on the downside. And why is that? And it didn't really seem to happen this month, or maybe it did. Maybe the numbers were actually stronger. I'm not sure.
Well, that's a great point. I mean, the thing I was going to point out is that over the last 5 years, the average revision between the government's first estimate and the third estimate. So just to be clear, our first look at employment, that number gets revised. So we know it's wrong. It's going to get revised a second time and a third time, and then eventually with the benchmark revisions. But that average revision between the first estimate and the third estimate for just August over the last 5 years is a positive 120,000. So odds are job growth this August is stronger than the 315,000 that we got to see today. But August is always quirky. Usually it's safe to take the under on August employment because of a low response rate. And I checked, and the response rate this August was actually the lowest since I think 2006. So it was a pretty low response rate. We were also going from a July reference period that had 5 weeks between them to one that only had 4. And usually when that happens, it biases job growth lower because you pull some of the jobs that would have been added in August into July. But so I think bottom line, I think, my gut is that you're going to see upper revisions to August over the next couple of months. Hopefully that offsets some of the downward revisions that we saw to the prior 2 months, which were 107,000.
Great. Anything else you want to bring up before we get the rest of the gang's perspective on the numbers?
No, I think we should let everybody else chime in.
Okay. Lots to digest. So Dante, you want to go next? Want to fill any gaps there in the job numbers?
I think Ryan mentioned participation. I think labor supply is the biggest positive news out of the report, right? I mean, that had been the thing that we've been sort of waiting for it to improve over the last 6 months. It had been just sort of hanging there, not really doing a whole lot in a positive way. And so we got a big increase in participation rates, across lots of different demographic groups. It certainly looks like people are, coming back into the labor force more strongly than they had been over the last, at least 6 months. And that should make the Fed feel better, right? That'll take some of the pressure off of wages, hopefully in the near term, satisfy some of that outstanding labor demand. So I think that, the increases in labor supply and participation are, the biggest positive.
I mean, the one thing I would add to Dante's comment is that what's driving job growth from a month-to-month basis is labor supply. The labor demand we saw in the job openings and labor turnover survey is still really, really strong. I don't know how the exact number is. Dante, is it more than 11 million, or Marisa, it's 11 million job openings, right?
It's in that ballpark still,
right? 11.2, 11.3.
So. Right. So there's
it's been there for a year, basically. The labor demand hasn't changed. It's strong, and it's been strong. Yeah. So supply is the big issue.
It actually improved in this.
Yeah.
In
July.
Yeah.
Well, let me ask you a question on the labor supply since we're on it. If you look at the growth in the labor force, so that's working age population times labor force participation. So labor force can be affected by both, and they both are lifting labor force growth. So if you look at year over year, well over 3 million people were added to the labor force. So you divide by 12, that's not quite 300,000 per month, but that would be consistent. If we were able to maintain that rate of labor force, that would be consistent with 300K in jobs and employment. So it feels like labor force has really come on here quite significantly, and that obviously is very important.
No, I would agree. it's probably a function of a few things, inflation, because, that's adding a lot to everyone's monthly costs to purchase the same goods and services this year as they did last year. And within inflation, gasoline prices, I think the past increases may have pulled more people back in.
Right, because they just don't have the income. The sort of lower income households just don't have the income to pay their gas, fill their gas tank and pay their rent and everything else. So they need to come back to work. That's what you're suggesting.
Right. In the establishment survey, because there's two surveys of employment, the establishment and the household. In the establishment, you can have double counting. So Dante and I are double counted. So we are employed at Moody's, but we also work at a university. We teach economics. So we're counted twice in the establishment survey. So there could be some multiple job holders in the establishment survey.
Oh yeah, I never thought about that. Right. Yeah. You're kind of sort of moonlighting.
Dante more so than I am.
Yeah. Oh, is that right?
Yeah, Dante's teaching like 2 or 3 classes.
Two now. Yeah.
Is that right? I had no idea. Well, we certainly need good professors at university. So it's good that
we also need Dante in the office. He leaves at like 4 o'clock on Monday, Wednesday, and Friday.
Hey, you're just making stuff up.
Aren't you his boss, Ryan?
Yeah, that is true.
Yeah.
Yes.
This is the
What's that all?
this is the annual review.
Yeah, this is it right here.
The annual review. Yeah, exactly. Okay, so Dante, from your perspective, any blemishes? I mean, Ryan had to go pretty deep to find the blemish. What was your blemish again? I can't remember. Duration of unemployed. That's going pretty down there to find a blemish. What about you, Dante? Any
Yeah,
blemishes?
I mean, mine's pretty nitpicky too. I think the diffusion index. So looking at how broad job growth was the lowest it's been since January 2021, and the second lowest since the pandemic started. It's still over 62. So 62% of industries adding to jobs, but it's definitely weakened over the last few months, and so it signals that job growth is not quite as broad as it's been recently.
Right. Okay, but that's still pressing pretty hard to find a blemish too, right? When you say, yeah.
Agreed. Yeah.
Yeah. Okay. All right. Next up, Marisa, what do you think? What's your sense of the report?
I think it's good. I think I don't really see blemishes in it. I think the increase in the labor force participation rate was quite large compared to what we've seen over the past year or so. I was looking at the unemployment flows data too. It seems like that is a big part of the uptick in unemployment is just people coming back into the labor force more specifically to look for work. And a lot of those people found jobs too. I mean, actually the people coming out of the labor force directly into a job was quite large as well. It just looks a little softer, the downward revisions, I guess, to July, June and July data make everything look a touch softer. But again, this is kind of what we've wanted. I mean, a gain of over 300,000 by normal standards is still quite a large month-on-month employment gain, right? We've gotten used to 500,000 jobs a month. But yeah, I mean, the breadth of job growth, as Dante said, the diffusion index was down a little bit, but when you look at the detail across industries, it's hard to find anything that looks really weak. So I think it's good. I can't really find anything bad in it.
Yeah.
Or concerning,
Yeah, the flows data is pretty interesting. So you're able to see folks exactly where what their status is currently with regard to the labor market, and compare that to last month. And you're saying that if you look at that data, that we're seeing a lot of people who weren't in the labor force at all last month, in the month of July, came back in the labor force in the month of August, and those folks who did, many of them went right to jobs. They didn't go to unemployed, they went right to jobs.
That's right. I mean, one interesting thing, again, if we have to nitpick and find something negative, is the number of people that stayed unemployed over the month rose, and that's consistent with what somebody said. I don't remember if it was Dante or Ryan, that the duration of unemployment has ticked up a little bit. People seem to be staying unemployed for a little bit longer. So that does suggest maybe some, just a little bit more friction in the labor market, which again is what we want, what the Fed wants. So it's all good. It's just a touch softer, which I don't think is a bad thing.
Right. Okay, good. So really, you had to nitpick too to find a blemish.
Yeah.
Okay. Chris, same with you. Same kind of assessment as the rest of the gang.
Yeah, you have to go deep, right, to find anything that's really concerning. So if you look at some of the demographic cuts, right, you can find some blemishes, but they're not major, and that data does tend to be more volatile once you start to cut. So if you look at, for example, less than high school educated individuals, their participation rate did fall a bit this month. But again, things move around there, or Black men and women, same thing. But so maybe something you put on your radar screen, but not something that screams that there's necessarily a problem right now. I think my biggest observation may be just what Ryan said early on, is that August data tends to be quirky. So I don't know that we want to read too much into anything, right? Things may very well get revised. So want to take this data certainly with a grain of salt. So overall, I think it's a good report, but pay attention, be aware that things might change. We saw that June got revised down by 100,000. So there's potential here for things to move around as well.
Yeah. Okay.
Sorry.
Yeah. Okay. So, it's hard to disagree with anything you guys said. It felt like a great report. I'd say just a great report. I mean, job growth is moderating, but that's the script. We clearly need job growth to continue to moderate, and we'll come back to that in a minute when we start discussing what this all means for the conduct of monetary policy and what the Fed has in mind. But certainly moving in the right direction there. And maybe I'll just, before I go on, just ask maybe you, Ryan, what do you think underlying job growth is? And when I say underlying, abstracting from the vagaries of the data, abstracting from these measurement issues that we get caught up in every month. What do you think fundamentally monthly job growth is right now?
Right, close to 400.
Really?
Wow.
No, I'd say lower.
350 to 400.
I'd say lower.
I don't know about that.
What would you say, Chris?
I was thinking the 250 to 300 range.
Yeah.
But like what the current trend is, or what is sustainable? Current trend, we're close to 350.
Current trend.
350 to 400. If you look at jobless claims, like that would argue that 350 to 400.
Yeah, I think that's true. That's true. I think if you look at like the 6-month average of monthly job growth, which is kind of sort of what I look at to get to underlying trend, feels like it's closer to 300K than 350. But okay, we're splitting hairs. Let's just say in the 300,000 range. I don't know, or maybe to settle it, Dante, Marisa, do you have a view on kind of the underlying monthly job trend?
I think I'm more in Ryan's camp than I am yours, Mark.
Yep. Okay.
You think it's higher?
Let's turn to Marisa.
Yeah, I would say about 300. Hopefully she agrees with you. Yeah, I think it's more like 300K. I mean, again, if you look at jobless claims, they're really low, right? And even they fell last week, and they're kind of hovering in a very, very low range, which suggests there isn't job destruction really going on.
I mean, over the last 3 months, the 3-month moving average is 378,000, and we know August is going to get revised. August is going to get revised higher, so I think.
Okay.
Yeah, I mean, 400. Like I don't know where Chris's pessimism came from.
He said 250.
Yeah,
I'm banking on some revisions here. in the other direction.
Can you actually,
Okay.
maybe, could you, Ryan, explain why August is weird? Is it the back to school seasonal stuff, or what? Why is it always off in August?
Yeah, so you have a bunch of quirks. You have, like you mentioned, the timing of when school years start across the country. Some start, mid-August, late August, some start in September, and that can change from year to year. Typically, August has a low response rate, so the share of establishments that are surveyed that actually respond is pretty low, and that's mainly because of vacations and people forget. Those are the key, and just these seasonal adjustment issues with timing of layoffs around the summer. Because August peak summer season, except for Dante and I, that's the peak, and you start to see layoffs and things like that. But the timing can get thrown off from year to year. So there's always some little quirks with August. Some of it I can't explain.
So just to get a number out there, given my sense of the distribution of responses to that question, let's say 350. 350K is kind of underlying monthly job growth. And just for context, and correct me if I'm wrong, and I'm sure you will, if you go back, say, towards the beginning of this year, it was pretty clear the underlying rate of monthly job growth was north of 500K. Would you agree with that? Okay. So we've gone from 500K plus to, say, 350. And taking this one step further, what is, let's call it break-even employment growth? What monthly job growth would be consistent with stable unemployment? And Ryan, I'll go back to you first. Do you have a view on that? Oh, this is a
I think I was thinking, I thought I calculated this recently. I think it's closer to 150 to 200.
Really?
What?
It's that high?
So that's population. You're saying population growth, right? That's the underlying.
Yeah.
That's the number you're talking about.
Maybe that's the break. Because I did both. I did break even job. Maybe it's closer to 100 to 150.
Yeah. I mean, the simple rule of thumb I use is labor force growth of 1%, let's say, and that's probably on the high side of what you can expect. So the labor force is 165 million. 1% of that's 1.65 million. So, you divide by 12. I guess that's, it's in the ballpark of 100, 150K, somewhere in there. That would be consistent with that. Yeah. Okay. So we were at 500K plus. We're now at 350K, and to get to something consistent with stable unemployment, it'd have to be something 100 to 150K. Everyone kind of agree with that?
Sure.
Okay. All right. Okay. Just to complete the assessment of the August jobs numbers, as I said, I agree with everything folks said. I guess I don't think anyone mentioned this, but the one blemish I saw was the decline in average weekly hours. They declined in the month by 0.1, which, not a lot, and that bounces around a lot, but that I guess is if you had to find a blemish, that would be the blemish. And maybe, did anyone mention wage growth? Ryan, did you mention wage growth? I mean, wage growth, I guess, is also kind of sort of a blemish in that, it's moderating. It feels like it's moderating, but it's still well north of 5% year over year, which
it was 5.2% year over year.
5.2, yeah. So that would not be consistent with the Fed's inflation target, right?
It's slower growth, though.
So, well, actually, I don't know. I mean, if you look at it, as wage growth as measured by average hourly earnings, which is what comes from this jobs report, that's been hanging between 5 and 5.5% since last fall. It really, quite stable. The growth rate's been quite stable. So, I guess good news that it's not accelerating if you're looking at this from the prism of what it means for inflation, but bad news in that, a blemish in that it's not moderating more significantly.
Yeah,
so,
I'd agree.
But yeah, okay. Yeah, but other than that, I thought it was pretty good news. And here's the other kind of thing I'd say. I mean, broadly speaking, from a labor perspective, I mean, this is Labor Day weekend coming up here, and just, you know, doing an assessment of the labor market more broadly, you know, it's good, right? I mean, we've recovered all the jobs we lost during the pandemic recession, and then some. Unemployment is low, back, you know, pretty close to pre-pandemic levels. Employment to population, another measure of the slack in the labor market, is back to consistent with full employment. You know, everything feels, you know, like, from a labor market perspective, you know, pretty good. If you're doing a broad assessment, would anyone disagree with that kind of perspective?
No.
No, we just need more labor supply.
Yeah, but yeah, you're right. Although on that front, if we're going to get more labor supply, it feels like it's got to come from working age populations, which means immigration, right? I mean,
correct.
Labor force participation it's down from pre-pandemic, but that would have been expected even if there was no pandemic, right? Because of the aging out of the workforce by the baby boom generation.
Mm-hmm.
Yeah. Okay. All right. Let's before we turn to the question of what this all means for monetary policy and the Fed, why don't we play the game, the statistics game? Is that okay with everybody? Everyone on board?
Sounds good.
Sure.
I don't know who I'm going to go to first.
Wait, Chris, do you have a cowbell? Or do you need a cowbell?
Always.
All right.
I don't have my cowbell, unfortunately.
You never
I'll let
do.
you guys lead the way.
You can't leave home without it.
That's everyone. Yeah. Actually, I've got a couple now. One in the office, one at home. So I'm prepared. Okay. So the game. We each put forward a statistic. The rest of the group tries to figure that out through questions and clues and deductive reasoning. The best statistic is one where it's not too easy, so we all get it quickly. One that's not too hard, where we never get it, and one that's apropos to the topic at hand or a recent release. So, okay, who wants to go first? Marisa, why don't you go first?
Sure. Okay. 10.1%. Ryan, why are you laughing?
No, because I know what the first question Mark's going to ask is if the sign is correct. But when you go with 10.1%, I think we're safe. All right.
Is the sign correct?
Oh,
Yes.
Did it come out today?
What'd you say?
10.1%. And this is a statistic that I derived out of today's employment report. Okay, so it doesn't appear as 10.1% in the report because I want to make it a little challenging.
You might have stolen my number.
is it a change?
I didn't steal anything from you. No, it's a proportion of something.
Oh, no,
yeah.
you didn't.
10.1%.
Does it have to do with unemployment duration?
No.
No.
It's not remote work related. No.
Did you have to use the household survey or the establishment survey?
The establishment survey. It's from the establishment survey.
10.1%. It's a ratio of something to something. It's in the establishment survey.
This is good.
This is a good one. Yeah.
Is this the share? Like, are you looking at like the share of job creation by a certain industry?
Mm-hmm.
Okay. Okay.
All right. Now we can just start guessing industries.
Just go down the list of industry.
Leisure and
and hospitality. Yeah.
Yes. That's what it is.
Ever, probably.
That's right. So it's the proportion of the change in private sector employment made up by leisure hospitality last month. That was 10.1%. And that's the lowest that it's been. I mean, this has been around almost a third of jobs, right, on average since the start of the pandemic each month has come from leisure hospitality. So this is the lowest it's been in quite some time, since the end of 2020.
Well, that's a good one.
And the reason I picked it is because because this has been such a contributor to job growth through this entire recovery, right? And it still added a lot of jobs last month. It was over 30,000 jobs on net, but that isn't even statistically significant in the establishment survey. And that's really kind of the first time since the labor market has gotten going after the pandemic that leisure hospitality kind of contributed a much lower than average share than it has been. So, you know, kind of going back to the diffusion index and the breadth of job growth and the labor supply question, this was maybe the poster child industry, right, for an industry that was hurting from a lack of labor and a lack of labor supply. Apparently the people that entered the labor force last month didn't necessarily take leisure hospitality jobs, but you know, this has kind of been the juggernaut of job growth through the pandemic. So it'll be interesting to see if this is just kind of a 1 month thing, because we know this is seasonal, right? Especially what Ryan was saying, the end of the summer and kind of summer type jobs coming off. But I think it bears watching.
And leisure hospitality is still, the employment level is still below pre-pandemic.
That's right. It's one of the only industries where that's the case still in the private sector. Yeah.
So do you think this is the beginning of a slowdown, or do you think a quirk? Or are we going to see a continuation of these? Yeah.
I don't know, right? Because I do think that unless we see sustained continued increases in the participation rate, then it could be a slowdown. I mean, eventually this industry's gonna, with the unemployment rate so low, gonna start running out of people to hire, and with job openings so high. So we got a nice bump in the participation rate last month. So we just have to see if that's sustained. And if it is, then, you know, perhaps it can keep going at the rate it has been. But at some point, this is gonna slow just because labor supply has been drawn down so much.
Yeah, just from my own parochial perspective, I hope they're not finished hiring in the leisure and hospitality industry. Every hotel I go to, it's, you know, there's an issue like
understaffed.
Well, I won't even go there.
Yeah.
Yeah. Oh, yeah. And I feel so bad for the staff, right? Because you can tell they're really scrambling. And I'm actually at a hotel now that the people are great, but you can just tell they're stretched, or, you know, running to do the valet, they're running this over here, doing that over there, and you know, they're doing their best they can, but it feels pretty like they're pretty stretched.
It's going to be more self-service, Mark. Yeah, you gotta make your own bed.
Make your own bed. Right, that's already, you know, obviously happening to some degree, right? But anyway, okay, so that was good. That was a good one, Marisa. Very good. And I shouldn't sound too surprised. You always come up with good statistics. You're Maven. Not as good as Ryan, but you're very good at this. Okay, Dante, you're up. What's your statistic?
77.2%.
Everyone's going with percents. All right.
Yeah. Is this
came out today?
Obviously, came out today.
Came out today. Yes.
Did you have to derive this?
I did not derive this. It's
okay.
As reported.
Is it an employment population ratio of a particular group?
It is not, no.
Does it go back to your diffusion indices?
No, it is a household survey, which I don't usually dive into, but it's a household survey.
Oh.
Interesting.
A participation rate?
It is a participation rate.
For a cohort?
For a cohort, yes.
All right, I'm just asking. Okay.
So that would be people between the ages of 35 and 44.
I got it.
Oh, Chris got it.
Chris thinks he has
this
it.
Was one of my. This was one of my backups.
I was going to say I thought you Googled it.
Labor? Nope. No. No hands on the keyboard. 25 to 54-year-old women. Labor force participation.
Ooh.
That's right. Prime age women. Oh. It eclipsed its pre-pandemic high, and it's actually the second highest reading ever. It's just shy of its high all time.
Wow.
That's a good one.
Well, here, this
Wow.
is something that we've talked about in the past, and that is the pandemic seemed to hit women harder than men, in part because they work in industries that got hit hard during the pandemic, healthcare and educational services and retailing and leisure and hospitality. But it feels like, correct me if I'm wrong, but it feels like by all these statistics, women have made it all the way back and then some. That there's no real distinction between how men and women have done since the pandemic hit. Is that fair?
Yeah, I think early on, right, it was the industry issue. It was also the childcare, school issue early on in the pandemic, and that has mostly subsided at this point. And now, if you look at participation for prime age men, it's been pretty flat to doing nothing, and it's still below its pre-pandemic level. And women are now back above, so it's a good sign.
And this is from my mind's eye, so I may have it wrong, but I think I'm right. I think female unemployment is now lower than male unemployment. Does anyone know if I'm right or wrong? I think I saw that in the report. No?
I don't know for sure.
Take a look. Yeah. Okay. Yeah. Marisa, do you have a sense of that? I mean, would you say that women have made it, that their labor market status is no different than men at this point? That they've fully recovered from the pandemic to the degree that men have?
Yeah, I mean, I think the recovery has been stronger among women than it has been among men, but that's also because they got hit harder, right? So kind of like everything during the pandemic, the things that went down the fastest have kind of come up the fastest. And I think we started to see that last summer when kids started going back to school and normal school years started returning to in-person learning, and vaccinations were widespread. So you had people start traveling again and getting out there. So you had a lot of the industries that women had been laid off in start to come roaring back. So yeah, and you're right. The unemployment rate for women is now below the unemployment rate for men.
Right. I got that right.
It's 3.5% for women, 3.8% for men.
Is that the first time since the pandemic hit that's been the case? That the female unemployment rate's been below the male?
No.
Okay. Here's the other thing, Dante. Remember all that work we did early on measuring labor force participation by different demographic, and we looked at the participation rate of parents, young parents, male and female. And correct me if I'm wrong, but I think, and this goes to the point about childcare, we found that the male participation rate of young parents fell just as much as, or pretty close to, that of women. Am I wrong or right? As I recall, that was the case.
I think it was more even than I think a lot of the sort of popular narrative was, that it wasn't quite as a disparate outcome as you might think. But I think when I haven't updated that data in a while, but I think last I had looked, female mothers had recovered pretty strongly. They had gotten hit pretty hard, but they'd recovered pretty strongly as of probably 6 months ago, the last time I looked at it, which signaled that I think a lot of the educational childcare impact had gotten much better as of earlier this year compared to 2021, certainly.
Wasn't the timing of that also a bit different? Like I think if I recall, I might be off, Dante, but initially when the pandemic started, it was more women, it was more mothers that left the labor force or stayed home. And then you saw that sort of a delayed effect that happened it was either much later in 2020 or even 2021, where you started to see fathers leaving the labor force more, almost as if there was like a switch or trade-off.
I think that's right. I think the immediate impact in April and May of 2020 was a much bigger impact to women, and then that recovered a bit, and then men started to come down a little bit sort of later on. So yeah, it might have been some sort of switching effect or something else going on there.
Mm-hmm.
Yeah. Okay. Hey, Chris, you're up. What's your statistic?
48%.
And that comes from the job numbers, I assume.
Nope.
Oh, okay.
Housing?
Okay, this
not housing.
It's not housing.
Not housing. It is jobs related.
Is it JOLTS?
Oh,
No.
I think I know what
No?
It
I
is
think
not.
I know what it is.
All right.
I think I know what it is. It comes from the ISN manufacturing survey,
Nope.
employment.
Nope.
Are we going conference board?
Yes.
It's not the labor market differential was 38, right?
That's correct. You are correct.
So
But
it's
that's
not
not my number.
Okay.
It's related. It's close, very closely related to that number, though. It's one of the
Jobs
components.
Oh, so you're
Hard-
saying this is from the Conference Board Survey of Consumer Confidence, and they asked
Yeah.
a lot of questions, so many of them labor market oriented, and this is coming from one of those questions
Yes.
that they asked.
And
Jobs
You
Ryan,
didn't
hard to
derive
find.
it.
what's that?
It's the share that think jobs are plentiful. You said it's a component of the differential. Yeah.
Correct. That's right. That's right. I'll give you
Oh,
half.
so what is
I'll let you two share a cowbell.
Well, I'm still in the dust here. What catch me up? So what was that number?
So 48% of respondents indicated that jobs are plentiful.
Oh,
And that's
I see.
lower
Is
than it's
that-
been. Yeah.
And that's been trending
That's down.
Yeah. It was 55% at the start of the year. It's been going down throughout there, which I found interesting because we also had the JOLTS number come out this week, which, as we mentioned earlier, actually ticked up. There are 11.2 million job openings, right? And it's been high all year. It isn't as though it's been falling. But the perception, at least from consumers, is that
From
jobs aren't
households.
quite as plentiful as they may have been before.
Yeah. Joel's being job opening labor turnover survey, another BLS survey that's lagged a month that breaks things down in terms of job openings, hires, separations, layoffs, that kind of thing.
Right.
Okay, well that's interesting. The one thing I did notice in the open positions in the JOLTS numbers, the number of open, you mentioned that it actually increased in the month of July, the last data point.
Yeah.
And I don't know if anyone else noticed it, but a large part of that increase was in financial services. It just felt weird that would be the case, right? Given all the layoffs going on in the mortgage industry, it just didn't feel right to me. So felt like a data quirk. And I, you might be asking why focus on that number and the answer is because the Fed is. I mean, the Fed is looking at those job opening numbers as a gauge as to whether the labor market is easing up enough to get wage growth down to something more consistent with their inflation target. And the JOLTS number went in the wrong direction. I think everyone, including us, was expecting the number of open positions to decline, and actually rose. But it looked weird. Would you agree, Ryan, when
Yes.
you looked at the data? Yeah. Okay. All right. Okay. That was a good one. Mixed it up a little bit. Ryan, what's your statistic?
0.2% month over month. And like Marisa, I had to
It's a
derive. You have to derive it.
Derived.
Yeah.
So it's a
Oh, boy,
growth
this-
rate,
This
a
one's hard.
month-on-month growth rate
Mhm.
in something?
one's
Was
hard,
it
but
out
it's
of the jobs
important.
report?
It is correct. It's an important number, but it's hard.
Huh.
Mark, you've
Household or
looked at it.
employment?
Chris, Marissa, Dante, you've all looked
Okay.
at it at some point.
Oh, interesting. And it's a month-to-month growth rate
Correct.
out of the household or employment survey?
Employment
Ooh.
survey. Establishment
Oh,
survey.
Really? He had to.
you had to
He had
stop.
to,
Yeah, I had to think for a
he
second.
had to stop. Wow.
I'm coming off
that's
2 weeks of
weird.
vacation.
All right.
Yeah, but still. Yeah. You're
Is
not
it
like
something to
Serena
do with
Williams.
earnings?
Ooh,
Is it
yes. Earnings is
a-
part of it.
Part of
Part
it.
of
But
it.
you said it was derived.
Yeah, you have to calculate it.
You have to calculate. It's not coming out of the report.
Not itself.
You have to
Nope.
construct it.
It's a growth rate in average hourly earnings of something. Am I
Yeah.
right?
Well, I'll give you a hint. Yes, you use average hourly earnings is part. That's one. Then you need the second part.
Oh,
Real growth or something.
No.
Hmm. Huh.
Second.
Huh.
I'll give you a hint.
Boy.
It provides some light into the discrepancy between GDP and GDI.
Okay. GDP, gross domestic product, GDI, gross domestic income, both
Correct.
conceptually measuring the same thing, but GDI is on the income side of the accounts, GDP on the expenditure side.
Mhm.
So income, personal income.
You're getting there. You're working yourself.
Are you taking like employment and hourly earnings and coming up with like total wages or something in one month?
You're
over the
getting
other?
very, very close, Dante. I
Oh
don't know.
yeah, that's what it is.
Mark's going to kick himself because he's already over so far today.
It's like something to do with unit labor costs or.
Oh, you guys are so close.
No.
All right.
No, this is like the proxy for labor income.
Very good.
Or wage and salary income. Yeah.
It's the labor income proxy. It's average hour earnings times
employment
hours worked, or the work week. Excuse me, the work week.
Okay.
So this closely tracks historically personal income for wages and salaries that feeds into GDI. So if you look at the growth in this proxy versus what actual personal income and wages and salaries is doing, would argue that the data that's going into GDI is being grossly overstated. So before we were thinking the revisions were going to be GDP closer to GDI, but it looks like it's going to be the other way around. I'll send you the chart. It's pretty compelling.
Oh no, I don't want to hear that at all.
Yeah, I know you didn't want to hear that.
So you're saying that if you take this proxy for wage and salary income, and you map that against gross domestic income, GDI, it looks like the GDI is overstated, compared to historical norms in that relationship.
Yeah, I didn't go proxy to GDI. I went proxy to the input or the source data that goes into GDI, which is personal income, for wages and salaries. And they usually line up. I mean, they're always not perfect, but they're pretty darn close. And over the last couple of years, this proxy and the source data have really diverged. So
interesting.
We'll see.
Can you send that to me? I'm really curious about that.
I was going to write it up for the site. Write it up for the site today, and I'll send you the chart.
Yeah, very good. Okay.
So what would GDI go down to?
I got to calculate that. That's
I got to calculate.
Question number 2. Yeah, I'm going to figure out what the revision would be. But right now, it looks like the gap is 4 to 5%.
Can I just say, there's only a handful of people on the planet probably understand what the heck we're talking about. I mean,
yeah, we just lost half of it.
Yeah. So just to make it concrete and clear, as everyone knows, GDP has declined in the last couple of quarters and set off this whole debate about are we in recession or not. And one argument against the idea that we are in recession is gross domestic income growth has been much stronger, GDI, and that goes back to the conceptually measuring the same thing, output of all the things that we produce, but looking at different source data. And we've been thinking that the GDP number is going to be revised higher, but here Ryan is suggesting, based on this other data from the employment report, that maybe no, GDI will be revised lower. But having said that, historically, the best measure of where the economy is and where things ultimately land in the data after all revision is an average of the GDP and the GDI.
Correct.
So it feels likely that GDP might be revised up, GDI might be revised down.
You just meet in the middle.
You meet in the middle, which, by the way, meeting in the middle would be zero. At least in the first half of this year. No growth. No growth in GDP.
But if you've noticed, the Fed has been putting greater emphasis on GDI.
I had not noticed that.
Mm-hmm.
They
in
are
the minutes.
putting...
Yeah, in the minutes, they have mentioned gross domestic income numerous times.
Of course, the GDI would. Well, I was going to say it's more consistent with the employment numbers, but now you're telling me no, it's not. Really? Okay, send me the graph.
I will show you the graph.
Yeah,
graphs don't lie.
Yeah, that's right. Until they do, but
well, they get revised.
Okay.
Well, they get revised. Yeah.
Yeah. Okay. Well, let's. I'm not going to give my number because it's all. You took every single one of my numbers in this conversation. I feel very inadequate, but we've done enough of the game. We got to move on. So let's talk about what all this means for the Fed in monetary policy. And Ryan, I've been going back to you first because you were away for a couple of these podcasts, so I'm putting the onus on you. What does this all mean for monetary policy? How is the Fed looking at this report, and what does it mean for the conduct of policy going forward?
Well, I think, as we discussed earlier, this is what the Fed wants. I mean, they're seeing exactly what they were hoping for. But the August employment report, I don't think, shifts the Fed either towards a 50 basis point rate hike in September or a 75 basis point rate hike. I think both are on the table. And what's going to make or break or ultimately factor into what the Fed will do will be the August consumer price index that we get in a couple of weeks. So a lot of Fed officials have said the labor market data is not going to change their opinion. It's the inflation data. They downplayed the July consumer price index and the personal consumption expenditure deflator, basically two ways of measuring the prices that you and I are paying. But August should look really good. We should get a decline in the consumer price index. So a number of regional Fed presidents have said that, if we get, another good data point on consumer prices, that may justify going from 75 down to 50. So I don't think August employment report changes anything. I think it's still up in the air. And that's what financial markets are saying. They're pricing in 60, 65 basis points of tightening in September. So they're kind of on the fence between 50 and 75.
And did that change with today's numbers at all?
A little bit, a small
Not really.
No.
Okay. I mean, at the end of the day, though, the Fed does want to see job growth continue to throttle back here, right? They want to get back to that break-even job number we were talking about earlier, consistent with stable unemployment, and we agreed that that's 100 to 150K, somewhere in there. That's where they, at the very minimum, we got to get there, right? And
yeah.
Do you think they would actually want to see it go below that? Something closer to zero for a while?
Yeah, to help get inflation, to ensure that inflation gets back down. So basically, their checklist is, all right, let's slow GDP growth, which they can check that off. Slow job growth, which they're in the process. I mean, they still have more work to do. Then they want wage growth to slow, and that ultimately will feed into inflation down the road. I mean, there's lags between each of these steps. So that's why, the Fed's got to be careful not to go too slow or too fast. It's a very, very narrow path to what we call a soft landing, where the Fed achieves their objective of keeping the economy at full employment and returning inflation back to 2%.
Hey, Marisa, do you have anything to add on into this conversation on what this job number means for monetary policy, the conduct of policy?
I think Powell was pretty hawkish, right? And kind of said, we have to go hard and we can't let up. And I don't think this changes anything. This is still a strong jobs report. And I agree, CPI is probably top of mind for them. But I mean, even if we get an expected slowdown in CPI, I don't know that necessarily means they don't go 75 basis points. I think they're worried about being behind the curve here, and the odds are they go harder.
Yeah. So given all the data we've gotten and what we're going to get before the September meeting when they decide 50 or 75 basis points, and everyone knows the CPI is going to be soft. I mean, we're going to get, in all likelihood, a negative CPI number because of the decline in gasoline prices and oil prices. What would it take for the Fed to do 50 then? I mean, all these numbers we've gotten and are getting would suggest 50. What would it take for them to go 50 and not 75?
I don't think there's any economic data besides the CPI, maybe UMISH, but I think they got enough flack for overemphasizing that the first time that they're going to downplay that. It would be financial market conditions. If they continue to ease or improve, then I think the Fed, it's guaranteed they're going to go 75. But if they tighten enough, then maybe the Fed says, all right, job growth is slowing. We're moving in the right direction. Inflation is moving in the right direction. And financial market conditions are back to where we wanted them to be because, they've improved since, the Fed said that, we have conditions where we want them to be. So I think that's watching financial markets is important.
Yeah. Okay. The idea being that the link between what the Fed does and the economy runs through financial markets and financial conditions, stock prices, credit spreads in the bond market, mortgage rates, value of the dollar, those kinds of things. And you're saying,
Exactly.
depending on how markets respond and react, will go a long way to determining whether they feel like they need to go 50 basis or 75. If financial conditions look tighter, meaning stock prices are down, credit spreads are wider, that makes it more likely that they'll just go 50. But if the stock market is looking better, credit spreads are coming in, the value of the dollar is coming down, mortgage rates are coming down, then it's more likely they go 75. So they're going to calibrate 50, 75 based on those financial conditions, which again is the link between what they're doing and what is happening to the economy.
Exactly.
Yeah. Okay. Chris, what do you think this all means, the jobs number means for monetary policy? Did we get it right? Are we missing anything?
I think you got it right. I think I agree with Ryan's assessment here. From the employment report today, I think they probably focus more on the wage component there. I mean, the employment is, it's kind of where they want it to be, maybe even a little too strong relative to what they ideally would want, but certainly within the range. I think that 5.2% wage growth is still too high for them. So, I mean, that certainly would favor more of the 75 basis point approach. But I think Ryan's right. It's really about, at this point, given what's left in terms of the data reporting before the meeting, it's more about financial markets and maybe expectations more broadly. That's going to drive their 50 versus 75 decision. Based on what we have today, I think they're going to favor the 75 still.
Really? Why?
Yeah, I think it. So you can look at this labor report in kind of two ways. Right? You could say, oh, well, and it's right in the middle, right? It's right in that Goldilocks position there. And you could say, oh, well, the labor market is still strong enough. I'm not really breaking the economy. I can afford to go a bit harder or even be hawkish here early on just to really nail down the expectations. Right? That's my interpretation. And still, given that the wage growth is still too hot for what they would like, why not err on that more aggressive side at this point?
Yeah, I guess. Yeah, I guess the other thing I'd throw out there that maybe they're focused on would be inflation expectations.
Yeah.
And I think you're right, Chris. That at the moment that would favor 75 over 50, because even after all that hawkish talk coming out of Jackson Hole, Powell's speech, and subsequent speeches by other Fed bank presidents, they feel a little on the high side to me. I mean, if you look at 1 year, 5 year forwards, that's inflation. This is coming out of the bond market, TIPS, Treasury inflation protected securities, inflation swaps. So it's inflation a year from now in the subsequent 5 year period, which I think we've talked in the past is at least my favorite measure of expectations when it comes to trying to assess policy, monetary policy. I look today, it's at 2.7%. That's consumer price inflation. So that's obviously high, right? The top end of the Fed's target is probably 2.5 on CPI, consumer price inflation. So, despite all that hawkish talk, it feels like it's still on the high side. So, I sense you're right. That might be the case. Dante, any perspective on this? Any disagreements with what we're saying in terms of what it means for policy, monetary policy?
Yeah, I think I'd probably side a little bit more with Chris. I think the JOLTS data popping up in July, even if it is a little bit quirky, certainly is probably unsettling that labor demand doesn't look like it's really come in much at all. And then on wage growth, I think the ECI is old at this point, but the last print you have from the ECI was actually an acceleration in growth in the second quarter, which obviously is unsettling to them, and they won't have the third quarter data yet. So I think the labor demand issue, even though job growth seems like it's slowing, I think there's still enough signals out there that the job market is strong and running hotter than they want that could easily push them to 75, unless there's a much bigger than expected decline in CPI. I think that's the only thing that might save that.
Yeah, ECI being the employment cost index, which is probably the broadest and most consistent measure of wage growth. It's just lagged. We only have data through Q2 of 2022, but as you're pointing out, that was a little disquieting on the wage front, continued strong acceleration. Okay, I think, Ryan, correct me if I'm wrong, but I think in our baseline outlook, we do have 50 basis points at the September meeting, and then 2 more quarter point rate hikes, and the terminal rate, so kind of where the Fed ultimately lands, is 3.5%, and they keep the funds rate target there through the spring of 24. Is that right? Do I have that right?
Yeah, that's our current baseline, but I think we got to make a decision this weekend if we're going 75 in September or 50.
Yeah. Okay. Well, we'll talk about that. Hey, very quickly, because I got to jump. What's the probabilities of recession? So I'm going to go around the horn here and get your sense of it over the next 12, 18 months. And Marisa, what's your assessment of the probability of recession over the next year or so?
49%.
Okay. Fair enough.
Can I get a decimal point?
Right up the line.
Down from 50 last month.
Ooh, that's progress. Very good. And the reason it came down a basis point?
I don't know. I just think
Your mood.
the data. Yeah, my mood. I'm less concerned about. Things seem to be heading in the right direction. I mean, yeah, the job market is still too hot, and the Fed could put the kibosh on all of this, and that seems the most likely kind of path we go down if we do get a recession. But I don't know, external to that, I think things look pretty good.
Okay, very good. And Dante, your probability?
Marisa actually stole my answer. I'd say just under 50%. I think I was probably 55% last month, and it's come down a little bit. I think we're on the right side of 50-50 now.
Oh, cool. Very cool. So can we say 49?
49 works, yeah.
Okay, good. Chris, Chris is definitely going to be higher than that. What's your probability?
I'm sticking with 60. This doesn't
60.
Wow.
No change.
0. No change.
Yeah. Yep. And Ryan?
I'm down closer to Chris now. I was at 65, but now I'm at 60.
Now that is fascinating.
Mm-hmm. That's even though we had a Volcker moment with Powell. I think, I think they have a better chance of pulling it off. I don't think they're going to pull it off, but I think they have a little bit of a better chance now.
Well, that's measurably better because you were like at 65, weren't you?
I was.
You came from 65 to you're 65, 60. Chris is holding his number at 60. I'm still at 45%. I think I was a little higher than that. I think I would have said 49, 50, maybe a few weeks ago, but I'm back down to 45. So feels like we're moving kind of in the more optimistic direction. It's hard to say we're optimistic, but moving in the right direction. All right. Well, very good. Well, let's we'll save those probabilities for posterity, and we'll come back to them and reevaluate next week. But anything else to add, guys, before we call it a podcast? Any other burning issues? I hope not, because I got to go.
All right.
Yeah. Oh, yeah. Happy Labor Day. Happy Labor Day, everybody. And we will talk to you next week. So with that, we'll say goodbye. Thank you, everyone.